You're watching Investors Guide on ET Now. If you've just joined us, we are reviewing our investments. In 2009, when we launched this show, we designed portfolios for different age groups and different needs. We are now tracking those portfolios to see how much progress they've made. We've already looked at our aggressive portfolios. We're now looking at the conservative portfolios. Dhirendra Kumar is with us in our Delhi studio. He is the architect of these portfolios. He's taking a look at them one more time. Our conservative portfolio is designed for a 55-year-old approaching retirement. Now remember, at this point, you should be moving all of your money out of equity to bring down your risk. This portfolio will protect your capital until you retire. In this portfolio are the FT India Dynamic P ratio funds, the HDFC MIP and the Reliance MIP. The returns have been impressive, 8.7%, but it seems to be a little aggressive, Dhirendra, 40% in equity. Are you comfortable with that allocation?
I'm comfortable with that. Ideally, I would have liked, this initially it was designed as a 35% to fixed income, to equity and remaining into fixed income. But given that what has happened and, the kind of, I would say that in a 5 to 7 year time frame, it should be able to beat the fixed income return. My target expectation is to be able to beat risk-free fixed income for an ordinary investor by at least 10 to 15% margin. These portfolios were designed as a low maintenance portfolio where an investor should not be actively making changes frequently, maybe an annual review and once in a while, and even less periodic changes. That is how it was planned, and on that front, I think they have turned out to be reasonably good and in good shape so far. I'm not alarmed by their allocation and the underlying characteristic of the equity portfolio.
All right, so we're not making changes to our conservative portfolio. I'm going to give you a recap of the funds in this portfolio. The FT India Dynamic P ratio fund of funds, 40% of your money going in there. HDFC MIP long term and the Reliance MIP. Remember, this is designed for a 55-year-old who's approaching retirement. One of the last portfolios we designed back in 2009 was our income growth portfolio. It's designed for an investor who has already retired and is looking to beat inflation in the long term. Now, when we're talking about this portfolio, we assume you've already taken full advantage of the Senior Citizen Savings Scheme, where you're allowed to invest about up to 15 lakh rupees if you are retired. Over and above that, you can invest in these funds: the Franklin India Dynamic P ratio fund of funds, HDFC MIP, Reliance MIP and the UTI Balanced. Now, this looks a lot like our previous portfolio except for the UTI Balanced, which is an addition. Take a look at the change in returns, 10.3% annualized over 3.5 years. Dhirendra, you must be proud of this portfolio.
I'm very proud of it, but one particular feature of this portfolio which is not getting highlighted right now is that this is all our other portfolios are accumulative portfolios. Here is a portfolio which is designed as a as an income generating portfolio. Of course, not very regularly, but this portfolio is designed in a manner that there is a lump sum investment and one is withdrawing, one is actually taking away 2% of the capital every quarter. And that is quite significant. I think the periodic withdrawal from this portfolio has not hurt the performance. In fact, on the contrary, the kind of volatility we have seen, the quarterly withdrawal from this portfolio to the tune of 2% of the initial capital has in fact enhanced the return because and that is out of that's sheer luck.
So Dhirendra, just to give our viewers an understanding of this portfolio, what we expect from this portfolio is to give us a return that we can withdraw maybe once a year or once every 6 months. It's not meant to be used as something that will give us a monthly return?
Yes, it was planned as a supplementary income portfolio because any market-related investment, you cannot bank on they generating periodic or bankable income at defined periodicity. One's first priority should be to get a guaranteed periodic income on which you depend, and after that your other goal should be make an investment in a manner that it is able to protect the value of your capital which is generating the periodic income.
All right, so this is our income growth portfolio designed for someone who's already retired, who's already using the Senior Citizen Savings Scheme, as Dhirendra was just telling us. I'm going to give you a quick recap on the funds. FT India Dynamic PE ratio fund of funds, HDFC MIP long term, Reliance MIP and the UTI Balanced. These are the funds. Now, if you have any questions about the portfolios you just heard about, Write to us. There's an email ID at the bottom of your screen. Now, continuing the Christmas gifts on our show this year, a couple of more investment tips. Naveen and Kapil are standing by. Merry Christmas to both of you gentlemen. Give us our investment tips for the year.
I would like to wish all the viewers of ET Now's Investor Guide a Merry Christmas. Talking about a commodity in the non-agri space, we will pick copper as a New Year gift or a Christmas gift to the viewers for the coming year. Copper in this particular year of 2012 has gained around 3.5%. We have seen the LME prices touching a high of around $8,700, and in Indian markets we saw the prices touching at around 104-160 or so in Indian rupee terms. The major reasons were the stimulus measures taken by the central bankers and at the same time the depreciation of Indian rupee, which imparted the bullishness to the copper prices in India.
First of all, wanted to wish the viewers of Investors Guide a very, very Merry Christmas. Consider diversification. One, understand your risk profile, understand the assets that you have, and ensure that the assets that you have are related to the risk profile that you carry. And secondly, please ensure that your assets are in a variety of products. You may have a favorite, maybe real estate is your favorite, but please ensure that 80 to 90% of your money is not blocked in real estate, because every asset class has its pros and cons. And lastly, I would say please plan your taxes. You should have already planned your taxes for the year, but if you haven't, please do it now. Don't wait for February to receive the mail from the finance team and then plan your taxes, so try and do it now.